excited to be a part of this panel today because I've been a part and involved with the NEC for a number of years, back since Seattle in 2008. And I don't think this conversation has ever taken place before. And it's such an important part of the big picture when we're looking at building a resilient earthquake community. So as Glenn mentioned, my name is May Claire. I'm with a company called CoreLogic. Some of you may be familiar with a previous incarnation of the company called EQE or EquiCat. We offer catastrophe risk analytics and reconstruction costs to the insurance, reinsurance, financial, banking industries, as well as some government entities. Today I'm going to talk about the role of catastrophe modeling in the insurance industry. So we all know that science is a big part of this, but how does it go from science into the insurance industry? I'll talk about how models are built, what they're used for, and then move into a little bit about how this is leading towards resilience. So when we think from an insurance perspective, we deal with risk. And when we look at risk, it's the entire perspective of risk. It's the full spectrum. It's not just about the big bad events that are going to be the most damaging. From an insurance or financial perspective, really need to understand what's the full spectrum of events that could happen. So on the far left-hand side, it's the high-frequency events, and I have a hard time putting earthquakes in this category at all. This is more reserved for events like hailstorms or floods that happen on an annual basis, where multiple events in one year could really impact the cash flow of an insurance company. On the far right-hand end of this spectrum are those the low frequency, really high consequence events that could really have a significant impact and from an insurance point of view could impact the solvency of the company. So if we look at this specifically looking at a few earthquake examples, something that I'd put in the more high frequency category or this lower end of damage would be something like the Napa earthquake that happened in 2014. It's an event that could happen anywhere, that level of damage, not a lot of damage, but enough damage to have a little bit of an impact. If multiple events like that happened in one year, it could become a bigger deal. Something similar to like the La Habra earthquake in the LA basin a couple of years ago. If we think about a mid-range event, that would be something I'd categorize like a Northridge earthquake. And that's pretty scary to think of Northridge being a mid-range loss event because up until time of Hurricane Katrina, it was the most costly disaster in U.S. history. And as Glenn pointed out in his own opening remarks yesterday, a repeat of that event in today's environment would be $75 billion in loss, and only a small fraction of that being insured. But everyone in this room knows that that is far from the worst-case scenario. Things on that far end of the spectrum would be things like the Cascadia megathrust event, which would expand from British Columbia down to California, followed by a tsunami, a large area of impact. Things like the shakeout scenario from 2008, which has more than $200 billion in damage. Or something like the Christchurch earthquake that happened in 2011. It was a direct hit on the city and had extremely high levels of losses, and the projected outcome for recovery is a considerable amount of time. So if we focus a little bit more on this spectrum and dive into the insurance perspective, what's really interesting to the insurance industry is understanding the probabilities of all level of losses that can happen. The common metric that's used is something called an exceedance probability curve, which looks at the probability of exceeding a certain level of loss at a certain return period. The example I have of that curve on the right points out 2 points, a 10% in 50 years or a 500-year event, and a 2% in 50 years or a 250-year event. Now, it's important to think that we're concentrating on this from a financial perspective. So those are return periods of a loss. So any event will have two different return periods. It'll have a return period of hazard and a return period of loss. And there could be, for a specific level of loss, a range of earthquakes that could happen at that specific level of loss. Some of them could be smaller magnitudes, some of them could be higher magnitudes, depending on where they're located, how damaging they are, and what the level of loss is. So when we look at building a catastrophe model, it's more than just science. What are the components that make this up? It all starts with the definition of the hazard, defining all possible events that can happen. So that starts by defining geographically every source that's available. So first of all, every known fault, and for areas where we don't know the faults, background seismicity or areas of regional area seismicity. Defining each of those events, and then a range of magnitudes, each of those sources, and then a range of magnitudes on each of those sources, and then a probability of each magnitude occurring on each source. So this makes up something that we call a stochastic event set, and these can be incredibly large. For the U.S., the model is based on the U.S. Geological Survey National Seismic Hazard Maps, and for California, USURF-3. And this is an incredibly large data set of events, of all probable events. For the entire country, it's about 118,000 events, and with about 38,000 of those being in California. So a large number of loss-causing events that could impact. So the next step then is for each of these events defining what the footprint of the event would look like. So taking a look at each specific event and how big is the footprint? What is the ground motion propagation for that footprint? So taking into consideration different attenuation relationships for different tectonic environments, having high resolution soil maps to understand how the ground motion will propagate, and other factors like liquefaction or deep sedimentary basins are there factors that could amplify ground motion within the footprint. The next step is where we go from hazard to damage, and that is the vulnerability component. And that's where we take into consideration what are the structures within this footprint of potential damage. This is where it's important to understand what the building is made of. So a wood frame building versus an unreinforced masonry building versus a reinforced steel building will have incredibly different damage variabilities. Also understanding how old is the building, what building code did it fall under when it was built. And what's the building used for? What's inside of the building? Is it a residential building versus a commercial building? Is it a factory? Is it a hospital? Knowing how the building is used can have an impact on what the loss could be as well. So for example, if it's a factory, even if there is no damage to the structure itself, if even one component of one of the conveyor belts of the factory is offset a little bit, that building can be completely unused. So understanding how the building is used, the structure is used, is very important. If it's a warehouse, for example, a warehouse filled with china has a very different vulnerability than a warehouse filled with toilet paper. So understanding what the structure is, what's inside of it, how it's built, and how it's used are all very important in understanding what the vulnerability of a structure would be. And then the final component is a financial loss calculation, and this is where we go from an estimate of damage to an estimate of loss. So this is commonly done with a sophisticated financial model that runs several 100,000 years of simulations. And why it's important to have several 100,000 years of simulations is because it takes each event and it samples it many times. And the more you can sample an event, the more you can decrease the uncertainty around that event. So in some areas where the hazard is really high and you can have multiple events in a relatively short period of time, you can get a lot of samples in. But in events for many parts of the U.S. where the hazard is lower and the return period of an event is very long, you need to have a long period of simulation to be able to simulate that event multiple times to get a better estimate of the loss with lower uncertainty. So once we have a model, how is it used? So we work very closely with insurance companies to help them understand how to gain good quality data, because a model is only as good as the data you input into it. So from an insurance perspective, it's understanding what is your portfolio of risks. So this example that I've used is just looking at a simple portfolio for the state of California. The colors are showing the distribution of the value within each county. The darker red colors are the higher value exposure, leading down towards the green and the gray, which are the lower value of exposure. So we can see here that there's a large amount of concentration of value in the LA County region. And that is definitely going to impact what we're seeing from the losses that come out of this. As a risk manager in the insurance industry, things that I'm going to be interested in is, where are my assets? What's the distribution of these assets? How vulnerable are they? Do I know how old they are? Do I know what they're made of? What is the value of each of these? And that is why having a good understanding of what your data is really important, and why when you go to have earthquake insurance, it asks you questions like, what year was your home built? What is your building made of? Do you have a chimney? All of these things factor into the vulnerability of your structure. So then just finishing off here then in using a catastrophe model, and we go back to having this full spectrum of risk, we ask questions like, where's my risk coming from? What faults should I be most concerned with? Will retrofitting help my properties? And do I need to diversify my portfolio? So I'm a seismologist, so I like to look at this from a very seismological perspective, and it's something that many of our clients do, is looking at which fault sources are driving my risk. When I look at that map of where all my exposure is, what does that mean in terms of where my risk is? Well, if we take a look at which fault sources are driving the risk here, we can see that it's the northern San Andreas, the Puente Hills, and the Santa Monica faults are the three most important ones for this portfolio. Now, that is because most of our exposure was focused in the LA basin. Had we had a different set of exposure, this picture would look very different. We also can look at things like looking at the magnitudes contributing to the risk. And here we can see it's the earthquakes in the magnitude 6.5 to 7 range that are contributing most to the risk. And that's about what we would expect to see, because these are damaging events that are happening on a fairly regular basis. Obviously, the very big events, magnitude 8 and greater, are going to be more damaging if they happen close to an urban center, but they don't happen very frequently. So a plot like this will help you understand what is driving your risk. Had we seen that the risk was being driven by events in the magnitude 5 range, we could take a look at that and say, well, that's something that could be fixed by retrofitting. So just some ways of looking into your data from the insurance perspective to understand where the risk is coming from and really understand what is most important. So just to finish off then, when we consider moving to a more resilient community from the insurance perspective, there's a lot of things to consider, and there's a long way we can go. One of my favorite quotes from Lucy Jones that she says quite often is, "The earthquake is inevitable, but the disaster is not." There's so much that we can do to be prepared for an earthquake, and from an earthquake financial perspective, we think about resilience and getting through the earthquake. We all want to live in our homes. We all want to go to work in our offices. We want our kids to go to school in their schools, and we want to be able to get through this disaster. We've seen reports from Christchurch that have shown that it could take up to 20 years for them to recover from this event. But wouldn't it be better if we could do better than that? So I've always said the first thing we can do to be prepared for an earthquake is believe it will happen. And awareness is the first step. And I think the California Earthquake Authority here in California has done a lot for helping the public be educated on what earthquake insurance is, what earthquake insurance isn't, that earthquake insurance is available to really give the community the strength to rebuild.
Claire, that was wonderful. Thank you. And there'll be time for questions at the end. We'll do the panelists first, but thank you very much. Next up is Lori Johnson, who's very happy to introduce. Lori, many of you know, has over 25 years of experience in urban planning and disaster-related consulting, management, and research. She's written extensively about these topics, particularly about disaster recovery, reconstruction, and the economics of catastrophes, which is such a fascinating topic. In the bio section in the folder, you can read about all the disasters that she has gone to and studied and written about: Sandy, Tohoku, Christchurch, Chile, and China, Katrina. But one that's not mentioned there is one that's close to my heart. In 1997, in the aftermath of the Great Flood of the city of Grand Forks, Lori was dispatched to help coordinate the federal response from the various entities that were playing a role there. And she played a significant role in helping that community get back on its feet. So it's a huge pleasure for me to introduce now to you Lori Johnson. Lori?
Thank you, Glenn. And happy Cinco de Mayo. I'm from South Texas, so I'm having a fiesta today. So I think one of the things that I should have done to set up my part of the presentation is first talk about what role insurance plays in a post-disaster situation in a community. And I think what's important, I'm going to talk a lot about what happens when you don't have insurance, which is the shape we're in with earthquakes. But I think what you do see, and the value of having insurance companies, is because when a really large-scale disaster hits, there's a simultaneous depletion of capital services. As Mike Galluli described, your infrastructure is damaged, your housing is damaged, all these things are simultaneously lost. And so you are instantaneously resource constrained. You are overloaded with the amount of decisions you need to make and the amount of actions you need to take. And so when you have insurance in the marketplace, For example, in California, I didn't know this, Glenn just said there's 23 participating companies in the CEA program. So it's not just the CEA that will be responding to that event. It's 23 insurance companies that respond to all kinds of disasters every day, that have very sophisticated claims management teams, that know how to interact with their client base, and have that relationship experience, and understand how to do damage assessment and respond. Backing behind that is really what Claire and the modeling industry has helped to sort of link up and make the insurance industry more robust, is a global reinsurance market. So every insurance company is actually spreading their risk to the global reinsurance market. So they have easy access to cash after a disaster, so they're able to bring that to begin to provide resources for the recovery, for businesses and residents in a community, and even local governments who are insured, who have insured their facilities. And so what I'm going to talk about now is really, I'm trying to use some other disasters as kind of case points for us to think about what a really large-scale disaster, not just in California, but in Memphis, in South Carolina, in New York, in Oklahoma, would look like with a really low insurance penetration. So the first place I'm going to talk. Wow, that really shrunk up. It doesn't really matter. Hopefully the rest of the slides don't look like this. But I'm going to go to Hurricane Katrina, August 29, 2005, near the last days of August. And really what this little graphic is showing is the amount of loss by state for storm surge and flooding. And the total was $44 billion in flood and storm surge damage across the 5 states that were largely impacted by Hurricane Katrina. Most of that was uninsured. Some people had wind insurance, but they didn't have flood insurance. And 88% of that total loss was in the state of Louisiana. And then the half pie chart there, the big green piece, is actually New Orleans. And I actually don't need this anymore. I just had some notes there. Okay, so what happened in Louisiana and Mississippi is really in the absence of insurance, because of the lack of updated flood maps. A lot of people actually hadn't known they were in a flood zone. The mortgage companies weren't necessarily obligated at that point to sell someone or to let somebody know they needed to have flood insurance. And so there were really variable penetration rates. On top of that, the levee failures actually hadn't been accounted for in flood mapping and aren't accounted for in flood mapping. So people that were considered safe behind levees then were subjected to catastrophic levels of flooding. So in the aftermath, and with this large uninsured amount, Congress actually did something that it had done at very small scales in Grand Forks and Northridge and a few other places, but did on a massive scale, which was to actually appropriate through a special appropriation beyond a federal disaster declaration, community development block grants. And there's a clause in the block grant program that allows for disaster recovery grants. And so those block grant allocations or authorizations were made in December, late December, so 4 months almost after Katrina hit, and June of the next year, so almost 1 year. And then the third one didn't come until November 13, 2007. Altogether, Louisiana received $13 billion in CDBG-DR grants, Mississippi 5.5, and Congress specifically directed that the majority of this funding had to be used for residential recovery. There was also oversight that was required because these are public funds, so there was a federal coordinator set up to make sure this was being done correctly, and also the state set up very extensive governance models, which I don't have time to talk about. So these are just some statistics about Louisiana and how they executed a residential recovery program to repair homes that had little insurance, maybe just to cover their limited bit of wind damage, but also lacked flood insurance. So they set up something called the Louisiana Road Home Repair Program. Over $10 billion of that $13 billion went to this program. It took over a year to secure the funding. The real funding for that, the amount of funding they knew to really launch the program statewide didn't come until that June 13th allocation. It took another year to really get the program up and running and to launch and review applications. So it wasn't until about year 2 that this money was actually starting to make it out. And years 3 and 4 is really when you began to see activity going on and repairs happening across New Orleans and southeast Louisiana. Altogether, 128,000 homeowners, very comparable to the scenario estimates of home damage that we expect for a major Los Angeles event, a major San Francisco event, and elsewhere. So 128,000 homeowners received over $8.5 billion in assistance. These grants had a pre-storm value limit of up to $150,000. This became very problematic because it was based on pre-storm value. And here's another issue, which is it's not based on the actual cost of replacement. Prices soared in the aftermath of Katrina. And so people who had a home that was very modest, a lot of poor income neighborhoods in Louisiana and New Orleans in particular, sued the state for this decision and eventually won. And so in 2011, the state had to go back and reallocate funding to a number of homeowners to bring that number up to date. So who's a state emergency manager? Or a program manager, earthquake program manager, state or local? Okay, just want you to kind of think about your living this life. There was also a rental housing program, and eventually the hazard mitigation funds for FEMA came through and they were able to link that in. But many in New Orleans described this as actually repairing the second floor before the first floor because they were waiting on these hazard mitigation grants. And you actually did even see houses sitting on cinder blocks, 8 feet of cinder blocks for several years before they could actually get the funding to come in and put the retrofit and elevation on their first floor. Whole other story about what happened. There's over 10,000 owners who actually opted to sell and not repair, and that's been a long-term issue for the state because it's had to receive those properties and then give them back out to the communities. They set up a trust to do that. They work with local cities to do that. They can't flood them back onto the market because that would really reduce property values in those neighborhoods immediately. And so it's a long-term program that is still going on today to try to bring those properties back into the marketplace and to cluster them and make use of them. Hurricane Sandy, we now set a precedence in the United States with Katrina and with these CDBGR, DR grants. And so again, we had large uninsured flood losses. And Congress did an appropriation, this time about 3 months almost, well, I guess 3 months after Sandy had struck on October 30th. And there are the numbers there for New Jersey, New York City, Connecticut, Maryland. It was really New Jersey, New Jersey and New York City in particular that set up large residential recovery repair programs. And those also had more ties this time that I'll describe to you. Also, the federal government had the National Disaster Recovery Framework in place. There was the President's Hurricane Sandy Rebuilding Task Force, and the state governors also set up these recovery oversight offices. So this is just a little bit about New Jersey's rebuild program, a $1.1 billion program. Now, instead of giving out grants and allowing the marketplace, people to have to go shop and find their own contractors and others to do their work. Instead now, HUD's been encouraging this form, which has been more that you actually now, as a state housing agency, function like a loss adjuster. So a lot of this ends up being outsourced to large consulting firms who then, in the case of New Jersey, a loss adjuster comes out. You are then allowed to select from a set of qualified contractors that the state's approved. In some cases where I was working in Seabright, New Jersey, people were given, this is a picture from there, basically given a set you could pick from version 1, 2, 3, or 4 of the repair. So you actually could almost like you had a choice of the kind of model home that you wanted. So the numbers go on there in terms of what they've been doing also on other parts of doing buyouts and relocations, doing rental repair and other issues. So I want to talk a little bit more about where Mike started or left off today with the Canterbury earthquake. And that's to talk about New Zealand's earthquake insurance program, because I think it's something that we also have some really useful insights from, because we really haven't had a large earthquake loss to compare to in the United States, and so this really is one of the best ones for us to look at. So in New Zealand, they've had since 1993 this nationally backed insurance program. It's what we call a first loss program, essentially provides up to $100,000. So if your house is valued higher than that, then you also have additional cover that you get on the private market. So everybody has a relationship really essentially with both the national government and they're a private insurer that normally covers their fire and wind, et cetera. And then the private market also handles the commercial insurance coverage. The EQC policy also has a statement in there for covering the cost to reinstate damaged land. And that's why the liquefaction issue became so big. So this is just some summary statistics of what they've done in New Zealand so far. Almost $10 billion has been paid out just through the national government's program. 167,000 properties with building damage claims. The claims number is actually much greater because there were repeat claims with each of these aftershocks. There were 68,000 homes that were in a home repair program. So the EQC was more like an insurance company where it just paid you and you went to the market and you did your own repairs until this point. And at this point, the national government said, we're going to have to set up something more like a home repair program like I described in New Jersey. And so that's what they did. Again, it took them time to set that up. But they repaired 68,000 homes. They're now at year 5, about 99% complete. And there were about 80,000 properties that had this land damage claim as well. And many of those, as Mike described, have been bought out. But a lot of them have endured a very lengthy process in actually having to figure out how to design an upgraded foundation and implement that as part of their repair. So what is likely to happen in a future U.S. earthquake disaster? Well, I think a big disaster, we're going to see a federal declaration. We'll see the state emergencies get engaged with FEMA to execute individual and household assistance, which has a cap at around 30,000. Public assistance, hazard mitigation programs. Insurers will be assisting their clients with claims management. There might be fire-related claims. There might be those who are insured. But there's going to be, even within those, issues of underinsurance, limits on coverage, a lack of coverage, and this will, as it did with Katrina and other places, ignite lawsuits, public and political pressure on the next speaker to insurance commissioners to intervene and provide reforms. And we're going to have this large uninsured residential loss, which we hope we will have a empathetic Congress for whichever state it happens in to get a large-scale appropriation. So we're going to be dependent on something like this from the federal government, or if we're lucky in California, we might be able to self-finance some of this in the larger states. So in this case, HUD pretty much puts constraints on the individual who can actually get this money. So it goes to state housing agencies. Do we have any of those representatives here? No. They're not generally at this conversation. Someone else for you state earthquake program managers to meet. They will get this money. This money is not going directly to cities, except for very few, very large cities. So states are going to have to put these programs together. Most of these agencies lack experience in earthquake damage or in insurance-like claims handling and payment repair programs. So in closing, what work really needs to be done ahead of time? I think for all earthquake program managers, really think about building into your work program some work to really understand what the disaster losses are likely to be in your state or your community, what's insured, what's uninsured. Maybe establish a state or local working group to understand these resource availabilities and gaps across not just the residential sector, but the commercial sector and the public sector. Promote earthquake insurance, but also education around what is and isn't covered with insurance, and develop funding resources for where you have your known gaps. And with that, I say thank you. Sorry, Tony.
Thank you, Lori. Commissioner John Doak, the Oklahoma Insurance Commissioner, had wanted to be here today. I know that because we spoke and he was excited to come, and he got a hold of me the day before yesterday and apologized, but something had come up and he was not able to make it. But he asked his associate, Buddy Combs, to represent him. And so my pleasure to represent Buddy to you now. Buddy is the Director of Public Policy and Assistant General Counsel at the Oklahoma Insurance Department, a state where there's a whole lot of shaking going on, Buddy. And I noticed Buddy joined the department in 2011. Now, when did things start getting really active there? Wasn't it about 2000? Coincidence? Buddy obtained his BA in economics and his law degree from the University of Oklahoma. And he began working for the Insurance Commissioner, as I said, in 2011, focusing on the development and passage and implementation of all new insurance laws and regulation. And there is, having been in that role for 8 years myself, a special place in my heart for the men and women in this country who work hard to make sure that our insurance marketplace remains strong and the protection that's provided to families as a result of all sorts of insurance products available for when it's needed. So please welcome Buddy Combs. Buddy?
Thank you very much, Glenn. So when I started at the insurance department in 2011, I never expected to talk to a group of people about earthquakes and earthquake insurance. It's kind of a strange deal to be talking to you today, but I'm very excited to do so. So in Oklahoma, we deal with a lot of natural disasters, mainly, as you know, tornadoes, wind, hail, flooding, you name it, we have it in Oklahoma. We have gotten very good at dealing with these disasters, from our emergency management people to our insurance industry, the insurance commissioner's office. The people of Oklahoma have gotten pretty good at mitigating risk and responding after a disaster. We take a lot of pride in that, strangely. We have a lot of tornadoes, we have a lot of floods, and so we have a lot of experience in this area. Now, one thing we haven't experienced a lot in the past is earthquakes, and that's become a big deal for us here recently. So I put this slide up here really just to point out, while we have experience with tornadoes and floods and the like in Oklahoma, what we don't have experience with is earthquakes. And I'm really preaching to the choir here, but earthquakes are the real big risk for large-scale natural disasters, as you all know in this room. And so shifting our focus from small-scale, although awful, disasters like tornadoes and wildfires into something much larger has been a big task for the people of Oklahoma. The next one, why earthquake insurance? So here in Oklahoma, we have undertaken a lot of work to educate the people in our state. And it actually started from the ground up. As we started to talk with consumers around the state, and we started to talk with people about why they should maybe purchase earthquake insurance, what it protected them from, we realized pretty quickly that there was a basic misunderstanding of how earthquake insurance works. People in Oklahoma have a really good understanding of how their homeowners policy works, specifically as it relates to wind and hail and things like that. They understand the deductible, they understand the coverage, they understand the difference between an actual cash value roof and a replacement cost roof and things like that. They're very, very educated and they understand a lot of things. But we had to start from the beginning and just simply inform people that your homeowner's insurance does not cover earthquakes. If you have damage from an earthquake, that's not going to be covered. And so that was kind of the initial question that we started to have to answer in Oklahoma. We really had to start at the beginning and educate our consumers about earthquakes and the insurance that covered those. So in Oklahoma, why earthquake insurance? You know that Oklahoma has a lot of shaking. I have some statistics. In 2013, we had 109 earthquakes in Oklahoma that were 3 or greater. In 2014, that jumped to 585 earthquakes that were 3.0 or greater, and in 2015, it was 907 earthquakes that were 3.0 or greater. So this has become a really, really big deal for us. In 2011, when I started at the insurance department, we had about 2% of our citizens, of our homeowners, that had earthquake insurance. That's jumped now to about 20%. So we've seen a large take-up of earthquake insurance. People are starting to understand this, but we still have a long way to go. What have we done at the insurance department? We've been very, very proactive in trying to educate our people. We have a PSA that runs on local radio, runs on television, giving the basics of earthquakes and what people need to know, directing them to our website if they have further questions. We have also held town hall meetings. You know, in Oklahoma, we have 77 counties, but only 10 of those counties have 94% of the earthquakes. And as you learned yesterday, a lot of it means because it's induced seismicity, those earthquakes are really located in the areas where there's a lot of wastewater injection from oil and gas activity. And so in those 10 counties, we hold town halls. We go into those towns, we invite everyone, and we sit down with people and we talk about earthquake insurance. We go through their policies with them. We make sure they understand them. We try to educate people on why they might need earthquake insurance and why it's important in case we have a large disaster. We also do radio and television advertisements. We do radio and television interviews. I've sat down in the last couple of years for probably 10 or 15 different TV interviews just to talk about why earthquake insurance is important. And we also, the commissioner has written several op-eds in local, rural newspapers to try to get the word out, just so we can get people a basic understanding of earthquake insurance and why it's important. So the economic cost of catastrophes. Like I said, I'm preaching to the choir in here. You guys know the economic cost of catastrophes. It's a big, big deal. Induced seismicity has become a big deal in Oklahoma. And we're worried, obviously, about the cost that comes to our state and what that means for us. And so, as we go through the process of informing our consumers, we try to inform them on a basic level. If you have an earthquake that brings your house down, the cost to you can be so significant that it bankrupts you. And we try to get that point across. So, what exactly do we do at the Oklahoma Insurance Department? So this is a picture from the Moore tornado in May 2013. A lot of you know about the Moore tornado in 2013. It was an EF5 tornado, very, very large. And just for reference, I think the insured losses of the Moore tornado in 2013 were a little over $1 billion. So that gives you some perspective of a huge tornado that we have in Oklahoma compared to the size and scope of loss from an earthquake. The ratio is quite significant. Also in 2013, in May of 2013, we had another tornado in Oklahoma in El Reno. It was actually the widest tornado ever recorded in El Reno in Oklahoma. So we learned a lot after that recovery about responding to natural disasters for our people. So because of those tornadoes in 2013, we actually had over 95,000 total insurance claims from those two tornadoes. And the commissioner loves this slide because he gets to put football pictures up. But the two large college football stadiums in Oklahoma, at OU, which is my alma mater, holds about 82,000 people. So if you think about that stadium full to the brim, we had about 95,000 individual insurance claims in Oklahoma just from the 2013 May tornadoes. There's some pictures you see there. I mean, the damage is devastating, but it doesn't even compare to what you might see from an earthquake. So what was our response? This picture here, what we did in Oklahoma was we set up what we called an insurance village. The largest insurance companies in the country, Allstate, State Farm, Farmers, Liberty Mutual, all of the big ones, their catastrophe response vehicles descended on Moore, Oklahoma. And we set up an insurance village where people who had insurance claims could very easily come and talk to an adjuster, talk to a claims specialist, get their claims started, because we know that insurance is key to getting people back on their feet as quickly and effectively as possible. The quicker that they can get their claim payment, the quicker they can start back reconstructing their house, the better off everybody will be. And we actually issued over 3,000, in 2 weeks after those tornadoes, we actually issued 3,000 emergency adjuster licenses, because the insurance adjusters in Oklahoma simply can't keep up with that number of claims. So we actually had 3,000 emergency adjusters come into the state to adjust claims, a lot of them with catastrophic disaster experience. We kept that recovery open for several months after that. We actually kept a team of people from the insurance department in Moore to deal with that disaster because the claims process for some people begins to drag out, and it's not just a 2-week process. For a lot of these, you'll see these claims open and being negotiated and finalized for 2 years after a tornado hits. We also held a series. This is a picture from the one we held on August 17th, 2013. We held a series of town halls and meetings where the insurance industry would send folks so that we could go around and make sure that the consumers who had those claims had people to meet with as well. That was 3 months after the tornado in Moore. Really, the last thing I wanted to talk about, and I'm really, really looking forward to answering questions, especially since there's so much going on in Oklahoma as it relates to earthquakes, was really to talk a little bit about the earthquake insurance market as it exists in Oklahoma currently. Late last year, November of 2015, we started to realize that we need to get information to our consumers who had earthquake insurance. Earthquake insurance traditionally has excluded man-made caused earthquakes. Now, traditionally, that's mining, oil and gas exploration. If you live a half a mile from a mine that uses dynamite that shakes your house, you have an easily identifiable, blamable person or entity that you can go to and say, that shook my house. It's not an earthquake. But then the question in Oklahoma has become, does that traditional man-made exclusion apply equally to an earthquake that's caused by wastewater injection and oil and gas activities? And so we required every insurance company selling earthquake insurance in Oklahoma to issue a clarifying notice to their policyholders that said, yes, your policy does cover earthquakes caused by wastewater injection, or no, they do not. And there are 156 companies in Oklahoma that sell earthquake insurance. Of those companies, 109 do cover earthquakes caused by wastewater injection. 31 companies have some sort of mixed coverage, some policies that cover it, some policies that don't. And what we found was only 16 companies didn't cover that. And so we felt that was very good for our consumers in the state. Another thing that's happening now, we've realized here recently that we might not have a competitive market in Oklahoma. And what that means for us is normally with property and casualty insurance in our state, if we have a competitive market, then insurance companies are allowed to simply file their rates with our office and begin to use them. We don't necessarily have any control over whether or not those rates should be used. But if we find that we don't have a competitive market for earthquake insurance in Oklahoma, then insurance companies have to file those rates with our office to be approved by the commissioner before they can be used by those companies. And we've actually seen here recently at least 2 companies who have filed 100% rate increases on their earthquake policies in Oklahoma, so doubling the annual premium. In addition, some of those companies and other companies have actually doubled or tripled the deductibles that they offer for their earthquake policies. So we're starting to see some contraction in our earthquake insurance market. We're starting to see some companies raise their prices, lower their coverages. And the other thing that we're really starting to see as well is there are some companies that are starting to not offer new policies for earthquake insurance. So they'll offer it to the consumers that already have it at renewal, but we're seeing some companies actually retracting that and not covering new policies for earthquake. So we're going to have a hearing in Oklahoma here in about 2 weeks. We're going to bring in all of our insurance companies. We're going to bring in consumers. We're going to bring in actuaries. We're just going to talk through these issues, and the commissioner is going to conduct a public open hearing for everyone to have their say, and we're going to have to decide whether or not in Oklahoma we have a competitive market for earthquake insurance. And if we don't, then we're going to have to make some corrections and go from there. So I'm very happy to be here, very happy to take your questions. Thank you so much.
Thank you, buddy.
Yeah.
Buddy, thank you very much. So I'm going to briefly just describe how California is set up to handle this risk, at least for homeowners who wish to protect their home. Years ago, decades ago, California passed a law that said to homeowners insurance companies, if you want to be in this state, you have to offer earthquake insurance. People don't have to buy it, but you have to offer it. And prior to Northridge, companies were fine with that. They didn't, frankly, understand the risk back in the 70s and 80s, and so coverage was out there. It was pretty cheap, and a lot of people had it. Northridge changed all that in a matter of seconds on January of '94. Property damage, $40 billion. Half of that was residential, and half of that was insured by these insurance companies who would put this cheap policy out there. And at that point in time, after moving through the claims paying process, some companies financially imperiled. The industry basically said, we can't do this anymore. They asked the legislature to eliminate that mandate that they offer earthquake insurance, and the legislature refused to drop the mandate. But they said, they take a first step and said, but here's all you have to do. All you have to do is offer this thing we're going to call the mini policy, just a bare bones stripped down little policy with not much benefits for anything other than the structure. Just offer that, and then you can check the box that you've satisfied the mandate. Companies weren't even comfortable staying in the earthquake market offering that mini policy. And eventually, most homeowner insurance companies in California stopped writing new homeowners business because of their fear of having more earthquake insurance on the books. And that was a crisis then, when you have a homeowner insurance market that doesn't work, you have a housing market that's going to fail, and that's what led to the creation of the California Earthquake Authority. 20 years ago, opened our doors, formed to allow companies to join us, like Allstate Farmers, the ones you see here on this list. These companies are participating insurers. They joined us. Then they could stay in the homeowners market and satisfy the mandate to offer earthquake insurance by offering a CEA policy. Similar in some respects to the flood program, but different in other respects too. One way we're different is we're required by law to charge rates that are actuarial sound. But we don't have agents. We rely on the agents of the companies who participate with us, and that's how our business is brought to the consumers. We're a public entity. I like to describe us as basically an insurance company formed by the state of California. We're not a state agency, but we're a nonprofit insurance company, basically, formed by the legislature, managed by 3 elected officials, the governor, the insurance commissioner, and the state treasurer, but entirely privately financed. There are no tax revenues that flow through our organization. Basically, we collect policyholder premium and we manage the risk, and we now have about 880,000 policyholders that we protect. We have a public mission: educate, mitigate, and insure. Educate Californians about the risk, help them mitigate against that risk by incentivizing them to do the right thing with older homes and get that retrofitted to improve the performance of that home in an earthquake and increase the safety for the people who live there. And then provide valuable insurance policies that are affordable to Californians. That's our public mission. So we're a unique insurance company. We look to reduce rates whenever possible. And in fact, we've been able to lower our rates a number of times over the last 20 years, combined 55% in rate reductions as a result of the best available science, which Tom Jordan spoke about yesterday, and a result of other things we've been able to do to lower costs and pass those cost savings on to our policyholders. And, pardon me, thank goodness we've been able to do that, because inflation has gone up considerably while we've been in business, but more importantly, the cost to rebuild a home has soared. Reconstruction costs have gone up 168% over the last 20 years. So if you take an average home in our book of business that would have cost $576 to insure, based on that reconstruction cost inflation, that policy would cost about $1,400 today. But as a result of the rate reductions we've been able to deploy, that premium has only grown to $700. We have beat overall inflation, in other words, and we beat the heck out of reconstruction cost inflation because we have a public mission and we're here to serve our policyholders. It's easy to get eyes glazed over when you start talking about, an insurance policy and the kind of things we cover. So I'm going to do this real quick, but to show you again, underscore our public mission. Let me just say that the contents, the elements you see here were the elements of that mini policy that was created back when the legislature was trying to keep companies in the market. They said, all you have to do is offer this. Well, this is what we were formed to offer as well. We cover the structure for its replacement costs. The mini policy contains $5,000 worth of personal property protection, enough for a nice television now, but not much else. A 15% deductible, that's the level of damage that has to be sustained before we can pay a claim. Loss of use coverage, in case you have loss of use of that home for a while, you have to live elsewhere while that home's being rebuilt, or a total of $1,500. Not very adequate if that home is unavailable for a while. And in the initial mini policy, there was no incentive whatsoever for people to retrofit. So that was the mini policy. That was then, but because, again, we are this public enterprise, we will take all comers, we want homes protected, we try to make our coverage just as valuable as entirely possible. Our policy has grown now to, beginning this year, include all sorts of new features that were not available before. Personal property coverage, up to $200,000 worth of insurance for the stuff in the home. Deductible choices ranging from 5% to 25%. It's now the consumer who gets to choose. Do they want to basically self-insure a small amount but have greater protection for more moderate events? Or they want a higher deductible which will lower their premium costs, but they're not going to get paid for that first amount of damage until 25% of the value of the home is damaged. They won't have to pay anything on the deductible. That's just what triggers our payment. But now the choice is up to the consumer in terms of what level of deductible they want. Loss of use coverage, $100,000. Now we truly can help people live elsewhere if they need to while that home is unavailable. And my colleague Janelle has led the way in terms of being able to allow us to now offer a decent mitigation discount for older homes that do the proper steps of retrofitting their home under the guidance that she oversees, now we can reduce the cost of that policy by up to 20%. So as you can see, basically, it's a new day at the CEA, and we're busy trying to get the word out in California that it is a myth to think that just earthquake insurance is a flexible, invaluable product that costs too much. That's no longer true. To help consumers see how they're now in the driver's seat, we put them in the driver's seat by getting them to our website, which I'll just demonstrate how this works. If someone can go to earthquakeauthority.com, click on Get an Estimate, select what kind of coverage they want. Let's say they want a homeowner's policy. Fill out a couple bits of information in terms of how old the home is and how many floors and what the address is. Then they can start to see how much an insurance policy would cost them based on the kind of coverage they choose. In this case, we pull up a view of a policy with this is kind of the mini policy I spoke of. 15% deductible and very little coverage through the other choices. Produces a premium of, what is that, $33? That's a month, by the way. And note that the choice is on 15% in terms of the selected deductible. But now watch what happens to that premium up in the upper right-hand corner. When you slide the deductible down to 5%, it increases the monthly premium because they're getting more coverage for it. But if you got someone who wants to go the other direction, self-insure more of it, and reduce their premium costs, slide that needle over to the 25%. And see what it does to their premium as a result. And a person could go through and make the selections on the other coverage items. They are in the driver's seat. Now Californians can choose the kind of policy that meets their needs and budget. And then finally, almost finally, we also now offer significant incentives for people in older homes to retrofit. You'll hear more about this afternoon when Janelle speaks. The Earthquake Brace and Bolt program, financial incentives to go in and brace and bolt the home. We started a couple years ago with a pilot program and did 10 homes. We did 600 homes last year. We're going to do 1,600 homes this year. We hope to do more than that next year. We're putting in place financial incentives, and we now offer that mitigation discount. So if someone retrofits their home, makes it safer for them and their family, not only have they done the right thing, they get to lower the cost of their earthquake insurance as a result. Now, finally, I would just say, from time to time, public's attention on this gets focused when there's a massive earthquake like Japan a few years ago. It gets refocused when there's an article in the New Yorker entitled "The Really Big One" that appeared last summer. It gets focused when a distinguished speaker says something like, San Andreas is locked, loaded, and ready to roll. Notice all the cameras out there this afternoon or this morning? So from time to time, public's attention can be focused. And in this consumer research that we've done, we have heard consumers say, you got to get our attention. We kind of know we live in earthquake country, wherever in the country that may be, but it's still a little abstract. You got to get our attention. So we moved a little bit away from the way we portrayed our company and our offerings in the past with pretty brochures that had nice homes and lovely families and this nice language, and no one was paying attention. So we have moved to a more get attention kind of format. And in closing, I'm just going to play for you a new television commercial that we just started running earlier this year. No sound.
30 miles of an active fault, and most Californians don't have earthquake insurance. That's about to change. Announcing a seismic shift from the California Earthquake Authority. Earthquake insurance you can afford. With more coverage choices, deductible options, and new affordable rates to fit your budget. Get the strength to rebuild. Learn more at earthquakeauthority.com.
So we thank you. Thank you very much. We put a lot of thought into this and vetted it with many of you, and we know we were starting to push the envelope a little bit. And we agree with the social scientists that say you can't scare people into action. So you can't do a movie creation of a home falling on a child, for example. And we're not saying the earth is going to explode. We're just saying, let's get your attention here. Let's have a different kind of conversation. And actually, it's getting pretty good results. So I know it's noon. Are there any quick questions, or how do you want to do this? Time to wrap up. We're around lunchtime. Janelle's giving me the hook. And so do you have an announcement, Janelle?
Nope, just before lunch.
Yeah. Come on up.
Well, I'd like to thank our panel once again.